if your business is able to operate without you being there, then what you've built is actually sustainable. You've got something with transactional value. And so they called back a year later and they said, well, you were right. I said, well, what'd you do? Well, we bought an RV. This couple was in Utah. We bought an RV. We drove down to Cabo. We spent a couple months in Cabo, and we drove up the West Coast and spent another 4 or 5 months in Alaska. And over that period of time, when we were there, our team was still generating business. And the two guys that wanted to buy the business, it was shown, hey, look, we were able to convert leads. We were able to generate really good cash flow from the business that you've built, husband and wife. And it's been proven out.
Hey guys, how are you? I want to thank everybody who is joining us today. Today, I have a really interesting podcast and an interesting guest. That's the reason why I'm so excited about the topic. Scott Wright joins us today. He's with RealTrends. RealTrends is a consulting firm out of the Denver area in Colorado. They've been in operation for around 40 years, and Scott has been with the firm for 10. Well, what do they do? RealTrends consults with brokerages and large teams to help them with their structure, to help them acquire other teams and brokerages, and also to merge or to sell. Scott and I know each other from the Real Estate Innovation Hub and really enjoyed getting to know him. But Scott, thank you for being here today. And if you wouldn't mind, just elaborate a little bit on my introduction of you.
Eric, first of all, thank you for having me. I'm honored to be here. It's been amazing getting to know you and seeing all the great stuff you're doing down in Texas. And I know that you guys are crushing it down there. So yeah, it's been fun getting to know you at the hub at Mike Del Preti's Real Estate Hub. I've been with RealTrends. We call it RTC Consulting now, kind of interchangeable for 10 years now. And we call it RTC because about 5 years ago, my partner, who's Steve Murray, who many of you might have heard of, who's the founder of the company, we used to do before we became just consulting. We used to do rankings, the brokerage rankings, which I'm sure a lot of you have heard of, the RealTrends Verified, the agent and team rankings. My partner, Steve, is the one who created that. He was actually the one who created the term sides, transaction sides. We used to do a lot of conferences and events and newsletters. I'm sure you've heard of the RealTrends. Some of you old school agents out there and teams may have heard of the RealTrends communication newsletter. It used to be a widely publicized newsletter. My partner, Steve, sold all that to Housing Wire 5 years ago. We kept the consulting side of the business. So we just do valuations, mergers and acquisitions, general business consulting. We still facilitate mastermind groups, mostly on the brokerage side of things. And like I said, like Eric said, I've been doing that for 10 years, really enjoy what I do, really enjoy understanding the whole ecosystem of this industry, but also focusing on my niche, which is spreadsheets and numbers. I'm a numbers guy.
So I got it. Okay, so I know the answer to this, but I want to ask you because I think it's interesting. What did you do before you were valuing brokerages?
So I started out in high finance out of college. I worked for Merrill Lynch for a while. I was a stockbroker. I did some back end stuff for some of their retirement planning group. I actually went over into the telecommunications industry for a while on the finance side of things. And then before I joined Steve 10 years ago, I was actually in the mining industry. For about 10 or 11 years, I did deep research and analysis, published reports for commercial and retail investors on mining companies. So gold, silver, copper, all that fun stuff. So even though I'm a finance guy, I can go through a mining report on certain deposits of gold and be an amateur geologist on that. So that's what I did before RealTrends.
That's, super interesting. And obviously I don't see a direct sort of path from valuing mines to valuing brokerages. What are the obvious and key differences between valuing a mine and valuing a real estate brokerage?
Yeah. So what I did in my previous job, my business partner and I, we would actually go in and evaluate kind of like what we're doing now. We'd actually look at the companies. So, we'd do a deep dive into the financials of the company, the operational structure of the company, and we'd prepare reports for potential investors that might want to invest in them. So it was not necessarily a valuation, but it was an assessment of how that company is doing in their market, in their niche, and then kind of translating that over to the brokerage side of things. We take deep dives into brokerage companies and teams, and this isn't just residential brokerage. We do all the verticals in real estate. So we do work for mortgage, title, escrow, property management, insurance, property casualty insurance, And so very similar, we kind of take a deep dive in the company as a whole, holistically. We take it apart financially. We look at the operational structure, we look at trends, and we put together an assessment of how that company is doing. And obviously, before I joined Steve 10 years ago, I didn't know much about the real estate side of things, but working with Steve, who's been in this industry for 40 years, it's been like drinking out of a fire hose. And I feel like over the last 10 years, it's been really fun getting to know this industry and doing what I do. I have a great time doing it. At RealTrends, we've done probably 4,500 valuations. Again, solely focus on residential real estate. So mostly brokerage, but also teams and the other verticals I just mentioned. We also we usually represent the sell side of M&A, Eric. So for example, a lot of the Compass deals that they've done over the last 12 years, we've represented the sellers in selling to Compass. Some of the larger ones we've done, we represented Long and Foster when they sold to Home Services back in 2017. At the time, that was one of the largest transactions in this industry. But the vast majority of our M&A work is for local and regional firms, for teams, for small brokerage firms. We've done over 900 transactions on the sell side of things. And so M&A is a big part of what we do. And then bringing together kind of valuations in M&A, we do general business consulting for teams and brokerage firms. We benchmark them. We benchmark their performance, both operationally and financially. How you doing compared to your peers? What are some changes you can make to increase your value or to position yourself better for the future? So we do all that general consulting. And by the way, all valuations aren't purely for M&A. In
Right.
fact, probably less than half the valuations we do, Eric, are for people who are interested in selling. We do valuations for, like I said, general business planning, death, divorce, partnership disputes, stuff like that. The reports we prepare have to be scrutinized by the court system. So we've got to make sure we are check the boxes, dot the I's, cross the T's. We do valuations for other purposes as well. But that's kind of what we do now. We also facilitate mastermind groups for brokerage firms around the country. And in masterminds, as you know, Eric, how you and I met I can't tell you how much I've learned from the one we're in together and
Right.
from the other ones that I facilitate. And it's amazing getting minds together, some of the sharpest and best minds in this industry, in terms of how they share ideas, how they brainstorm together, and how they help one another. So it's been fun. And that's kind of what we do. That's kind of the long way of what we do here at RTC Consulting at RealTrends. And boy, do I have a lot of fun doing it.
That's great. That's super, super great. So just a thought, the masterminds are hugely valuable. Team leader mastermind could be something that could be interesting for you guys as well. I know myself, like I've always had mentors. I've always had, people that I consider like sort of parallel with where I am to bounce ideas off of as well. And the different perspectives they're super important. You reach a point where you need fresh ideas, you need more, you need more, right, of that. And the Innovation Hub is so far the only mastermind group that I've found that really satisfied that for me. And then you started telling me about the mastermind groups you have, and seems to be hugely valuable. So I want to kind of lay out like what I think we'll discuss today, or what I'd like to discuss today, and how it's relevant to everyone. First of all, a lot of agents watch the show, and a lot of team leaders watch the show, and I want to help them answer the question, like, how do I retire? And I think that, talking with you about that doesn't seem necessarily like the most obvious discussion that we would have, but it makes a ton of sense, because when we've talked, brokerages and large teams tend to sell or whenever it's kind of retirement time, right? And then when we've discussed, those issues that they run through and how do they make sure they look more valuable, it's really applicable to team leaders, and it's also applicable to agents. Beyond that, there's a lot of curiosity out there just around, how do these mergers and acquisition deals come about? Finally, I have zero interest in selling this company probably ever. I would love to consult with you at some point in time on like, what does a succession plan look like when I'm well into my 60s or 70s? But I think it's very important to look at the metrics and the valuations that you perform and to say, how can I increase that for my business? And the reason for that is that you guys know it's successful. So if we modify the business in a way that makes it more valuable in the eyes of an investor, we're probably making the smart business moves. Would you agree with that?
100%.
Yeah.
Absolutely. It's always smart to take a holistic approach into the business you're building. And Eric, that business is a broker owner like yourself. It's a team, and it's an agent book of business. Every agent, every team, every broker, it's their own business is what they do. The agents and teams that are with Brownlet partners are running their own little businesses. So that it all interconnects.
100%. So you have the most experience with these, like, I won't say large because most of these are, I mean, you've done some really big deals, but local brokerages that you've helped, what does that look like? Who is usually selling? What does the process look like? And then I'd like to get to how do they do it the right way?
Right. There's a lot of different reasons why somebody would choose to sell. One of the biggest things we've seen over the last 10 years, we'll call it the silver tsunami. You're actually an anomaly as a broker owner. The average age of a broker owner is probably like 65 years old. And this industry has really aged out. There's a lot of firms that are aging out and they're realizing that they don't have an internal succession plan. So from an M&A standpoint as to why a broker owner would choose to sell, it's to monetize the business that they've built because they're transitioning towards retirement. That's the most common reason why a broker owner would sell externally if they're getting at a certain age. They're done. They want to take some eggs out of the basket. So and they maybe don't have an internal succession plan, whether it's family or other leaders within the organization that either want to take over the business or are capable of taking over the business. And so they come to us and say, okay, let's figure out what we got. Let's figure out what we could be worth. If it's a price that I'm comfortable with, that the market's willing to pay, then let's go out and take our company out and sell it because I'm interested in moving on to the next step. Or if it's not somewhere where I think we need to be, going through that valuation process, I can't tell you how many times we deliver a report to somebody. They're like, man, I thought it was worth way more than that.
Right.
So let's lean in for a few more years, see if we can, build some value and then maybe see what happens after that. Obviously, you're at the mercy of the markets, but if you've got a plan and a roadmap to try and get to a certain point in the sale of your company, then we can do that with you as well. But again, a lot of the wave of M&A that we've seen recently is broker owners, especially for the smaller, local, independently owned firms who don't have that internal succession plan, who need to sell from the outside and are looking to monetize their business. I mean, so that's one of the main reasons why a broker owner of a privately held company would consider doing an acquisition, is because kind of like you said, the whole point of our discussion here is retirement, and retirement looks different to a lot of different people. And then you start planning at different phases depending on what your business is like. But that's what we've seen a lot of. It's that silver tsunami. I mean, we've seen a lot of that lately. Frankly, another big reason, Eric, why we're seeing a lot of sellers and why we've seen sellers in the past and why we'll always see sellers is you've got brokerage firms who, especially in the smaller sides where the owners might still list and sell, they kind of backed into owning a brokerage firm. But they might have been top producing agents or top producing teams. They are energy attracted other real estate professionals. And all of a sudden they kind of wake up and they've got 10, 20, 30 agents working for them. They realize, oh my gosh, I'm spending more of my time on the operations of the company than I am on my own personal business. And frankly, I don't enjoy the operations side of things as much as I enjoy listing and selling. So a lot of the smaller acquisitions we see are owners who are weighed down by the operational burden of running a brokerage firm and want to go back to their first love, which is listing and selling. Not everybody has that passion for operations and for coaching and training and for building other people's teams like you do, Eric. And those are the type of people that realize let's get out of this. Let's roll our firm into to a bigger organization that provides better services and products than I may be able to provide to my agents while allowing me to go back to what I love. So there's a lot of different reasons why people want to sell. And then there's the big one, right? If you're at a good point in the market, some people just time their selling correctly. They've built something wonderful and the market is rocking and rolling and multiples are as high as they've ever been. They don't need to retire. They may not be 70 years old and need to sell. They may be younger, but they've built a really good asset, a really good business, and they are looking to maybe either go do something else because they're not ready to retire, and they're looking to sell and monetize and take advantage of the opportunities where it's a really strong M&A market.
So a few things there. I mean, one, that sort of perfect scenario is really interesting. You're just kind of describing Mark McLaughlin in Northern California whenever he sold, I think for 50 million or something like that to Compass, because that number is like 500% 500% larger, 5 times larger than any sale I've seen. But back to let's call it the broker owner, which I would say a lot of these in Austin, Texas are teams, so 15 to 30 agents. You have a producing team lead or producing broker. I've been there. I was there for a while, and it's a desert. And like it is impossible. I will say impossible. I'm sure somebody can do it, but for me, it was impossible to be both an excellent sales agent and an excellent leader manager, right? So one side is suffering. Unfortunately, you have to get to a size to where you can personally stop producing, and then you can begin leaning into the management side. Then you have this big desert until you can start hiring more staff to actually make your life more pleasant. So I look at the 15 to 30 agent brokerage/team. It's a really good question to look at that and say, do I want to continue doing this on my own, or do I, can I take on some help? Because it is lucrative to sell. The most money I'd ever made in my life was whenever I was still selling in 2017. Now, after a few years of that income going down in order to build the business, it did go back up after that. But it's an ordeal to go from that, let's call it 30 agent count, to, I don't know, I think it probably scales at around 100 if I had to guess. I can see that would be a big part of your business. Whenever these deals are put together, something that we always see like the dollar amount. Okay, this sold for this, right? Sometimes you don't see a dollar amount, and I always just know in the back of my mind, there's no dollar amount disclosed. It was probably not super high, but the perception is that this team is sold or this brokerage is sold and there's a check that's written and that's it, and they walk away. That's not how it's structured, correct? Would you mind explaining how these deals are structured with the front end, the earnout, and the back end?
Well, first of all, you're 100% correct. In this industry, there's no such thing as all cash up front. When it comes, one of the questions I get the most is, what are the multiples? Multiples are a pretty wide range, and there's a lot of factors that go into where you fall in that range. And I'm going to talk about the brokerage side of things right now, because they could differ from how we value teams. On the brokerage side of the business, first of all, we've got a business, we've got an industry where we're not producing physical widgets. We're not producing a physical product that can be stored, inventoried, sold, retailed, that's immune to certain cycles in the market. The assets, and I hate to say the assets for a brokerage firm in our industry is almost all goodwill. And that asset is an independent contractor, agent, or team who it's their choice as to whether they want to stay with you or not. And there's no contract with them. Agents can wake up the next morning and decide they want to hang their license at your competitor down the street. So because of that, because a brokerage firm's value is really based on the goodwill of, the culture that a good solid brokerage firm has created, that has that reputation of doing good work for their agents, their teams, coaching, training, all the good stuff that builds strong culture, that creates strong retention, and that also fosters growth, of a brokerage firm. And so I preface that, making that statement, because multiples in our industry just in general aren't as high as other industries. You go out to tech, you go out to manufacturing, you go out, whatever industries out there, multiples are a lot higher. We get people coming in and from outside of our industry and look at how these companies are valued. They're like, oh, wow. Once you explain the process to them, they understand why. So factors that go into the marketability of a company, where they might find fall in a multiple range. And I'll just say, let's say 3 to 5 times adjusted EBITDA, or more normalized net income, cash flow, operating net income, however you want to call it. For brokerages, it's going to be in that 3 to 5 range. Depending on your size, depending on your location. Are you in a major metropolitan area? What's your market share? Are you doing, are you in a rural area? Your size, size matters in brokerage. The larger you are, the less risk there is if you've got agents coming and going. The concentration of sales, and we talked about this earlier, if you're a smaller brokerage firm where the owners still list and sell, there's a lot more risk than if you're a larger brokerage firm where the concentration of sales is not just on 1 or 2 or 3 agents. It's spread out amongst a really good, solid team of agents that are producing. And so all those factors determine where that multiple is going to be. Once you determine what that value is, what that multiple is going to be, then okay, if we want to sell our brokerage firm, back to your original question, how does that structure work? What does structure look like? And this is applicable for both brokerages and teams. There's no such thing as an all cash deal. You got to spread the risk between the buyer and the seller. And so usually there's going to be a portion up front. You got to have some skin in the game. If you're buying a business, you've got to write a check. Period. And that's your skin in the game. It's showing that you're invested in this. I'm going to write a check at close. I'm going to give this to the seller. That upfront portion changes a little bit depending on the state of the market, depending on how strong M&A is, depending on what the transaction looks like. For a big, strong brokerage firm, some of the best in the business, you're still only going to get half down at closing.
Got it.
There's going to be a big chunk of that purchase price that's going to be contingent upon the performance of the business after the sale. And that's the same for any transaction of any size, from the biggest and best brokerage firms in the country to the smallest brokers to teams as well. You're going to get a portion up front, and that's going to be anywhere between 20 to 50% at closing. And the rest of it is going to be based on performance, which is an incentive for the seller to make sure that that transaction goes smoothly, to make sure that those agents that are involved in that transaction are taken care of, are satisfied that what they're getting as part of that transaction is going to make their business better or not change it. We don't like change. As agents, we don't like change. So there's always going to be that back end portion, and that could range anywhere between 2 and 5 years, depending on how patient a seller might be. It could be beyond 5 years. And that's just, again, that's the art of the deal part of it, right? The art of the deal is coming up with price and terms that the buyer and the seller both feel like they're sharing the risk in a transaction.
That's interesting. I mean, as I understand it, then you're getting, let's say on a good day, half up front, and then half at the end. And so if they've lost business in that time, so meaning like agents have left or agents are producing less, then on the back end there's going to be less money for them. And that's on a strong deal, right? So you told me once that there are some deals structured where there's no money on the front end, like if it's a weak market, distressed sale, and 100% on the back end. And obviously nobody wants that. What would you say? I mean, on average, are these deals, they get a check up front and then 2 years later they get their second check, or what does that look like?
So they get a check up front at closing. And then a lot of times the way it works is it's based on the agents that are there at the time of the transaction. And that's measured sometimes as often as quarterly. So every quarter, or maybe every 6 months, at the most a year. So let's say it's a 3-year earnout. Let's say it's $1 million up front, and just for simple numbers, $1 million up front and another $1 million over 3 years. So that would be $333,000 per year over those 3 years. A typical deal structure would be, okay, after that first year, how is our company dollar or gross margin relative to where it was at the time of the deal and how this got priced? If it's lower, then it's going to be less than $333,000. If it's higher, it could be more, depending if there's a cap put on it or not. And that check is written every year. So it's not written at the end of the deal. It's written as you go based on performance. It's all contingent based on the performance of the company. If value is, and this applies to brokerage firms, to brokerages, teams, whatever. Value is always based on the trailing 12 months, or most of the time. Most of the time, it's based on trailing 12 months. This is a what have you done for me lately industry. A brokerage firm, their agent roster at the time of a transaction might be completely different than it was 2, 4, 5 years ago. And so most purchasers out there only care about what have you done for me lately. If this firm were to operate the way it did over the last 12 months, over the next 12 months, what's the cash flow going to look like? And so based on the trailing 12 months, we calculate what that company dollar is. And if over the next 12 months after that transaction is closed, that company dollar, or that gross margin, gross profit, whatever you want to call it, is the same as it was in the previous 12 months, you're going to get your full earnout. If it's lower, you're going to get a little bit lower. If it's higher, if it's uncapped, then you're going to get a little bit higher. Both the buyer and the seller works if it's higher. So why cap it? A lot of purchasers like to try and cap that. If I'm representing a seller, I want it to be uncapped to reward you for growth. I know we might touch on this in a little bit, but when you sell your company, there's a period of time where the seller needs to stick around. And, if they've got the opportunity to, number one, keep the agents happy and retained, but also continue to recruit, you want to be rewarded for that. So that earnout gets paid usually on either quarterly, semi-annually, or annually basis, depending on the performance, as it's measured against the performance of the period of time right before the sale.
Got it. Moving on to, okay, so how does this look for teams? And let's call it like not a large team, not a really small team. Let's say it's a team of 10 total agents, team leaders still producing. Do you want me to put like a production number on it too, or just 100 million? Let's just call it 100 million a year in sales. What does something look like? That team leader wants to retire. How does that person begin the process of selling the team? Are they allowed to keep producing after the fact? What does this look like?
Yeah, so backing up a little bit, taking a little bit more of a 30,000-foot view, when we're talking about teams, and this goes for agents as well, but when we're talking about teams and agents, one of the things we need to make sure we look at is understanding that teams are an income generating business and not necessarily an equity building business. Now, it can get to that point, and I'll explain that in a little bit, but that needs to be your focus as you're thinking about the possibility of monetizing or selling that team. Understanding that your business is income generating, it's not necessarily equity building. And that's just the nature of what we do as sales agents and as teams. And what do I mean by that? It means as a real estate agent, as a team, you're generating a lot of income. You're doing well, like you said, Eric. You're making a lot. If you're a good sales agent, if you're a good sales team, you have the potential to make a lot of money. And so it's an income generating business. It's not necessarily an equity building business because you're never going to see like a 5 or 6 multiples a team. Low multiples just in general for teams are lower than brokerage firms because of that risk of what happens when the leader goes away. Teams should treat themselves as income generating businesses, not as equity building businesses. And I mean, you really have to get to a very large team size or develop some kind of a business system where you've got significant non-SOI lead gen. SOI meaning sphere of influence. What does that lead gen look like? If you've got a business system that's built, then you might have that opportunity to build more of an equity type of business that has transactional value. But in general, most agents and teams, it's an income generating business. That's the mindset that needs to be when we're assessing how do we monetize our book of business? How do we monetize our team? How do we think about retiring? The process of retirement, when you are an agent, when you're a team, it starts now, no matter how old you are. Even if you're in your 20s, retirement starts now. The way you generate retirement is by investing the income that you're building as you're successfully running a business, the income generation that you're doing. And I'm going to give you examples. We had a team that this might be 6-7 years ago that came to us. She's in Southern California. She was in her late 30s and doing, $10 to $12 million of revenue a year of GCI, big team, making a ton of money. And we went through the valuation process with her, and we're like, listen, you've developed a really good team. You've got a phenomenal business here. You're making a ton of money, but the best I could probably do for you is a 3x, of your adjusted, net operating cash flow. And only a third of that's going to be up front. The rest of it's going to be contingency based on the performance of the business after the sale. And so she's like, well, why would I sell?
By the way, that's always the question, is that if I'm going to get paid 3 times what I profit, but then I need to stick around for 3 years, why wouldn't I just keep doing what I'm doing? It just doesn't make a lot of sense,
That's exactly right. And that's what we told her. We're like, well, you shouldn't. Run your team for another 3, 5, 10 years. Vest the cash flow that you're getting. And when you're truly ready to walk away, whether it's age, health, you're tired of selling real estate, whatever, then we can develop a plan to monetize. So have that income generating mindset in terms of how you're planning for your retirement at the beginning. Then at the end, we could shift to the equity building business just because of the way teams are, the way they're structured, and the way we could develop a sales plan for your team.
Yeah, that's great. So, I mean, I think that I think it can sometimes be a hard pill to swallow for high producing agents and team leads because they can generate so much money. It's such a lucrative business that you look at it and you say, this has to be valuable, right? I mean, just round numbers. Like there's a lot of agents out there that can make $1 million a year, right? I mean, that sounds insane, but there are agents in our firm that do. And you go, well, I have this systemized. I know what I'm doing. I can sell this to somebody. But at the end of the day, it's the relationships. That's what's truly valuable, and then the expertise. And so I fully understand why it's difficult to sell, something that's based on a relationship, like an SOI based business. So with that said, like, what do you do? I mean, if you're you've got this team, for example, who's crushing it, who's doing 10 million a year in gross commission income, like whenever she's ready to hang it up, she doesn't just like turn the lights off and walk away, right? I mean, that'd be insane. Like, what do
Yeah, that's a good question. And so before I dive into that, the the way I see teams is there's three different kinds of teams. And this will kind of build into what we're talking about here. There's a personality team. And a personality team is a top producing agent who is the rainmaker who is spinning off more business than they can do themselves. And, they're good at what they do. They've got this dynamic personality. They're good at marketing themselves. They've got, some kind of a good, they've really understood how to work their sphere, their database, whatever. Their personality has developed this really good, high producing team or business. Then there's the convenience team. The convenience team is where you get two or more agents that come together where there's a synergistic relationship. It could be a husband and wife. It could be, just general business partners, two agents that get along, best friends, whatever. And they share transaction coordinators that back one another up when they go out of town. They're both top producers. They're generating good business. They've got enough business to where they may need to bring on a buyer's agent or two. They can afford to have a full-time admin or a transaction coordinator. It's a convenience team of, some top producing agents that have gotten together. These two types of teams, the majority of their business is SOI based. The vast majority of teams out there, personality teams, convenience teams, their teams are based on sphere of influence, repeat referral, a really good marketing system that still focuses that marketing on themselves and what they've built. Those are the type of teams where it's a little harder to sell. It's possible. And we'll get into how you could sell your team. The third type of team, which is the less common team, the realm of building that equity, the business sale is we call it just a business team or a systems team, where their team is more than just the sphere of influence of the team leader. It's more than just the team leader's rainmaker ability, their ability to tap their own personal database. They've created a lead gen system that's independent of their own sphere of influence. And there's different ways you can create that. There's a lot more rare. A systems team or a business team with that lead gen system independent of SOI is a lot more rare. There's a lot more opportunity to create transactional value out of that. The multiples are going to be higher than that because it's a lot easier for the
transfer it?
leader to go away and that system to continue to generate leads. And if you get a good, competent listing agent or two or three, they can continue to close business. To answer your question, how do I do that? So when we're doing valuations of teams, regardless of what kind of team you have, the way you build value in teams is three ways beyond a transaction fee. So as everybody knows, when agents and teams go off into the sunset, historically, usually all that's remaining is building some kind of a referral fee system to where you can pass your business on to somebody else and get a referral fee out of it. The way you build an opportunity to monetize that beyond just a referral fee is one of three ways. Number one is having that, like I talked about, having that lead gen system, which is very hard to do and very uncommon, where you really are generating those leads. Number two is where the owner is not listing and selling anymore, the team leader. They've got a team where even if the majority of their business is from the owner's sphere of influence and database, the owner has stepped away from listing and selling, and they've got a good team of listing agents and buyer's agents that are taking care of that business and able to convert the vast majority of those leads without the owner needing to be on that listing appointment. So if you've proven that you've got a team where they're able to operate without the owner being there, then it's, then that's an opportunity to build equity value on that team. Or if you're really planning ahead, you've got somebody internally that you're confident that can convert your database. It's called a soft transfer. And this takes years to develop. This is why it's important. One of the reasons why we're having this call is if you've got a top agent or a team that's got other agents that are working with you, if you really are intentional about how that soft transfer is going to look, it takes years to develop that other listing agent that can go on your listing appointments with you, that can, where you could develop a plan where you could start to phase away. I'll give you another example. We had a team that we did a valuation for a number of years ago, and this was a husband and wife team. They built a great business, and they weren't doing much listing and selling anymore. And the two guys that were internally that wanted to, that had a lot strong interest in acquiring this team from them were very hesitant. They didn't know if they could do it. They weren't sure if they either trusted the value or if they were able to truly do it without the owners there. And so the owners looked at us and said, what do we do? We said, okay, go away, see what happens, leave town for 6 months, see how your team operates. If your business is able to operate without you being there, then what you've built is actually sustainable. You've got something with transactional value. And so they called back a year later and they said, well, you were right. I said, well, what'd you do? Well, we bought an RV. This couple was in Utah. We bought an RV. We drove down to Cabo. We spent a couple months in Cabo, and we drove up the West Coast and spent another 4 or 5 months in Alaska. And over that period of time, when we were there, our team was still generating business. And the two guys that wanted to buy the business, it was shown, hey, look, we were able to convert leads. We were able to generate really good cash flow from the business that you've built, husband and wife. And it's been proven out. So really, until you can answer that question, if you left town for 6 months and your team won't miss a beat, then if you haven't answered that question, then you are still valuable to your team. A lot of teams won't ever get there. It's really hard to get to that point where the owner can leave for 6 months and that team can still close leads, convert leads, and generate the same type of business without the owners there. But that's how you determine if there's transactional value. If that team can generate business without the owner being there. And what we tell teams, Eric, and I've told you, I've talked about this before, how to build value. The less valuable you are as the owner and the leader of that team, the more valuable your business is going to be. The more valuable. Yeah.
I was going to say, we talked about that in Boulder the last time I saw you. It was a group chat and I think if anybody wanted to have, one takeaway that how valuable is your business, right? Well, if it requires your presence, the business is not really that valuable. You haven't built something that can stand on its own. And I would also throw in that, you need to carve off. If you're a team leader and you're trying to say like, hey, this business stands on its own and it's valuable, you have to carve off your own production, right? You have to say like, okay, if my production makes up 80% of the team production, well, that's problematic. You have your business, but you're not running necessarily a team that's worth a whole lot. I'm sorry, I've got to ask you one more question, right? So the couple that proved the value of their team by leaving for 6 months and having an epic vacation and everything ran, why did they sell? Or did they sell? I would have proven to myself, like, maybe I just need to keep this thing going as long as I want it to keep it going, right? That's what I've come to is like, if I reach this goal of being able to be gone, our next stress test will hopefully be next summer when we leave for a month or two. And yeah, at that point in time, it's like, why would I possibly sell this thing? Like I can just leave and have fun and like everything the wheels stay on. So
that's exactly right. And to answer your question, it kind of circles back to what we were talking about earlier. This couple, they were older. And when I say older, they were in their 60s, which isn't old because, I was just at a brokerage firm where their top producing agent was 88 years old. So that's not old, by the way. But they had treated their team as an income generating business. They'd acquired a lot of wealth over their probably 3 decades of listing and selling real estate and developing and building out that team. They created a really good database. They didn't need the money anymore. They were ready to, while they were healthy, travel the world, spend time with their grandkids. So they had built their business up based on that. We're gonna retire over the course of 30 years because we're gonna develop assets, get assets outside of our business and outside of the value of our team. And so we're ready to hang it up. We're ready to go. We've got enough personal wealth. We're gonna leave town. We love to travel. We want to travel for the rest of our lives and do it while we're healthy. We want to, that should be everybody's goal. You don't want to. It's why take your money to the grave with you? If you saved and invested, do stuff you enjoy while you're young and spend your money while you're young. And this couple had done that. And so they were at the point where they were done with sales and they wanted to try and find a way to monetize their team. And they had proven out their business model to where the two purchasers were these two really good 30, 40 some gentlemen agents, male agents who were really adept at converting the listings that this team was generating off of these leaders' databases. There was other things, other ways that they had developed their marketing in the neighborhoods that they were in. That's the reason why. They didn't need to anymore, and they truly were ready to retire. They were ready to hang it up and go do something else.
That's awesome. Okay, so as you mentioned, most teams aren't going to get there. Like most teams aren't going to like most team leads continue to produce, and again because it's incredibly lucrative. And agents, individual agents, or agents with an assistant or two assistants, by definition, they're not going to get to that equity value. So what do they do? Let's say that they don't have a hard line of retirement, but they start drawing down. What does that look like? And you touched on it a minute ago when you said they need to start developing relationships with other agents. But what would your recommendation be to somebody who is 55 years old, has been a high producer for 25 years, and they're like, "Hey, look, I can see the horizon. I can see retirement on the horizon." What do you tell that person?
Yeah. If you're truly looking at stepping away from the business and getting to a point in your life where you don't want to do the hours and the effort that it takes to maintain the business at your current level, then it's about establishing those relationships and establishing that, you and I talked about before, there's this, the golden handoff. There's somebody that wrote a book about the golden handoff, right? I mean, handing off a book of business you need to plan well in advance. You need to make sure you develop relationships. If you're an individual agent with another agent, if you're a team, bring in somebody internally that's adept at converting leads, at converting your leads, who you not only trust, but you've started introducing and developing those relationships with your database. I'll give you an example. You have, one of my business partner's best friends was one of the top producing agents here in Denver, and he was ready to retire. He didn't, he had some personal wealth. He had some savings. He could probably retire without having to listen to sell anymore, but he wanted to get something for his business. He was a $20 million producer, and he developed he was a high-end agent. He developed a really good database. And so what he did was he found another agent in his firm that he trusted, that he had a good relationship with. He said, "Okay, look, here's my plan. I want to retire. My wife and I want to move to North Carolina to be with our daughter and um, our grandchildren. And I don't want to be here anymore. But I've built this business. I built this database that I believe continue to generate business." So what he did was he took this other agent and he introduced him over a period of a year to his top 50 clients, whether it's, having dinner, lunch, coffee, wine, whatever, introduced him to his top 50 clients. And when he decided it's time to hang him up, there was no upfront cash. If he passed on the rest of his database to this other agent, several hundred, contacts in that database, and they developed a referral fee relationship. And they said, "Okay, for the top 50 I introduced you to, I'm going to get a 35% referral fee. For the rest, it's 25%. And it doesn't end, by the way. And so in the first year or two, a lot of this guy's content, clients would continue to call him. If they trusted this other agent to take this listing, he'd hand it off over that first couple of years, and that other agent would get it from a soft transfer, calling directly to that agent. If they really wanted him to stay involved in the deal, he'd co-list it with this other agent that he developed that relationship, and he'd get the referral fee. That's 12 or 15 years ago. He's still getting about $40,000 to $50,000 a year. We just talked to him about 6 months ago. And, obviously there's a level of accountability there, right? I mean, you can still look at the MLS and just, see which deals are closing. But that's the typical referral fee relationship, but that took time and effort for this agent to develop that relationship with another good listing agent that can take over his book of business. If you don't have that opportunity to, if you're just an individual agent, or maybe you're a team that's just really just hammering your sphere of influence, and don't have that opportunity to create that equity value and possibly have a transaction where it's based on more than just a referral fee, then you've got to start building those relationships now. Start developing those relationships with the other agents that you trust with your clients.
I mean, and I would say, test drive it, right? Like if you don't have a lot of chances. If you pick the wrong agent and you discover it 2 years later, you could have messed up your book of business.
Yeah.
So test driving ahead of time prior to saying like, "Hey, I'm done," handing off some of this business to an agent or two agents or whatnot that you trust could be a good idea. That's a phenomenal outcome, right? I mean, if he's ready to retire, and then 12 years later, he's still getting $40,000 or $50,000 a year in residual income on this. It's a great deal for him. Want to point out too, it's a great deal for the agent who took on the business because there's no money up front. And certainly that might seem excessive. Oh, I have to pay 35% forever. Well, yes, but that referral source is also going to send you referrals. So the referral value of those relationships is incredibly high. And I think when people set aside, nitpicking or greed or whatnot and say like, no, I understand, like the whole ship's going to rise and I'm not going to worry about what's going to happen 10 years from now, 15 years from now, because we both succeeded along the way. I can see that being a very successful relationship. I could also see that being hard to find the right person that looks at it that way.
It is hard. And you actually hit something that's really important in our experience of having a successful transaction, and that's greed. What we tell a lot of folks is, listen, greed will kill a good deal.
Right.
If you're truly ready to retire and walk away, it's kind of the theory of the long tail. Think about the long game. That example I gave you of that agent who left Denver to go move out of town, and the way he developed that other listing agent or that other agent in general with him was the theory of the long tail. He didn't make this guy pay a ton of money. He didn't pay anything up front, and he developed a relationship with this guy to where it's really creates a measure of income over a period of years and decades. And so as a seller, you really need to make sure that you understand the type of asset you have,
Right.
and what it's that asset, the potential of that asset in the years after you're not there. So don't let greed kill a good deal. That's hugely important for, especially an individual agent's book of business that they're really trying to transition into retirement and passing that on to somebody else.
Got it. Super interesting. And I think this is something that Mike Morgan and I have talked about this a lot very recently, that there's not a true path out there. I mean, there's no blueprint that's been published that people say like, hey, this is the way to go. The book that you mentioned, The Golden Handoff, is the closest it gets. And I think that like laying out a path for agents that are in their 50s, 60s, whatever it might be, to draw down, to work less, and then ultimately hand off is good. I've heard the word coast into retirement before in a negative, where you don't plan ahead and you just sort of coast.
Right.
And what happens is you just stop working as much, and you really and then you just stop working entirely, and you've left so much on the table whenever you do that I think planning and foresight is really, really beneficial here. High return on investment for that.
Yeah.
So I don't know the answer to this. Your marketplace, can you describe a little bit about what you guys are building? Are you going to include teams? Have you thought about including these sort of referral relationships in this marketplace? Can we talk about that for just a few minutes?
Oh, that's great. One of the things I think before we maybe get into that, giving you a couple of other examples, if I can, you have time.
Yeah, 100%.
So there's a million different ways to skin a cat when you're trying to sell your book of business and your teams. And kind of before we get into the marketplace of potentially connecting buyers and sellers that don't have a relationship, some of the other things we've seen work in terms of taking over a business, towards of successful team transactions, and again, anecdotals is the best thing I could share with you. We had another transaction that we worked on a few years ago where it was down in Colorado Springs. I'm in Denver. Down in Colorado Springs, there was this couple that had created this great team, and what they had was a really good brand, and they had a really good direct mailing system that generated 20 to 30 transactions a year just from that direct mailing from the part of the market that they were in. And so they found another team in their market that they were interested in selling their team to, and their business to. And again, this is that transition from just a referral based relationship to actual transactional value. And so what they did was they proved, because this is very important. If you're a top agent, if you're a team leader, if you want to try and develop a saleable business, first of all, you need to have good record keeping. One of my biggest recommendations to you is make sure you really do a good job of tracking your conversion rates, tracking your lead sources, having good, reliable financials. You need to make sure you're very transparent if you're trying to sell a business. This team had done a really good job proving out that they've had a direct mail campaign over a 10 to 15 year period that was absolutely proven out to develop this constant flow of leads that had a high conversion rate. And so they had this system, and they were able to prove this system. They got, a couple $100,000 up front. and they developed an 8-year plan. They said, hey, listen, I want $1 million, but based on the performance of the business, either we get to 8 years or $1 million, whichever comes first. That's how we're going to develop the strategy of selling this and liquidating this team. So there's other options there. We've seen, another anecdotal is there was a really good brand here. And again, this is Denver, but this could be applicable to any market. There was a team owner who had developed a really strong brand, and these two gals wanted to take over her brand name. And so what she did is she developed a similar referral type relationship, as I mentioned before, but she licensed her brand name to these two other agents that she had proven was able to generate leads based on her reputation in the market, based on her brand, rather than, an earnout based on the performance of the company. She just did a flat out 5% off the top of GCI over a
Wow.
5-year licensing period. So there's a
Yeah.
million different ways to skin a cat, a million different ways for team owners to monetize, to build something, to prove out that they've got a business that's saleable. But whether you're able to create that transactional value or whether you're just selling your book of business, making sure that you've got a really strong record keeping, really clean financials. You don't want dirty data. We call it dirty data in our industry. Make sure you have clean data that you could show, and you're transparent with that that you're able to transition that to somebody else. So that those relationships are key. So those are some of just some anecdotals and some examples of how we've seen transactions work in this industry. Not everybody's a Mark Spain or a Robert Slack, or what are some of the other big teams out there? Ben Kinney.
Like Gary Ashton or somebody like
Yeah,
that.
some of these. Yeah, the guy in Nashville. Some of these giant teams that truly have these amazing lead gen machines that could be worth actually more than brokerage companies if you could prove that you really got that lead gen down. Um, Back to the marketplace question, one of the things that we're trying to do, and one of the biggest snags we find in M&A, and this is not only for brokerage, but for teams as well, is the last thing you want to do is to scare your agents by them finding out that you're for sale. So what we've created is, with our partners over at Fiji, is this marketplace. It's a reverse marketplace where if you're a buyer, you could actually go out and advertise yourself as a buyer. So Eric, you might have some teams in Brandlet Partners that are still have a lot of miles left, and they're maybe interested in growing and acquiring other teams in their marketplace, either within Bramlett or elsewhere in the Austin market. You can go out there, create a buyer profile, and sellers can go into this marketplace. They can go through the valuation process, and this works for teams as well. We already have the team valuation app already up. You go through the valuation process, figure out what your value might be if you've got that team value, and you can explore who the buyers are anonymously. You can chat with them with these anonymous chatbots, and figure out if there's an opportunity to consolidate with them. So if you're a buyer, it's a great place to be to create those, to grow your team via acquisitions. If you're a seller, it's a good opportunity to find out if there is any value in your team, or brokerage. And if there is that value, to explore who the buyers might be out there. We're still in early development on this, so we don't have the critical mass yet as to all, and have good buyers out there for all the markets. But that's something we're working on. One of the things that really excites me about the group we're in, Eric, is just all the innovation that's happening in our industry, the whole ecosystem. And this is something we're trying to do in our little niche of, where we can, insert some AI into it, insert some anonymity into it, and create a marketplace where people think that they've been too scared or didn't know that they could actually sell their business, because you can sell your business if you build it correctly and you develop something that has transactional value. There is a saleable aspect to it, and so creating that marketplace kind of breaks down those walls that have been there for M&A in our industry. And most M&A is small deals. It's not the big deals that out there that get the headlines. It's the small deals that happen.
So I don't want to take up too much of your time, but you mentioned big deals and M&A. I have to ask your opinion on I mean, did you guys put that deal together? The Anywhere
I
Compass?
wish. Yeah, the Compass Anywhere deal, that one
Yeah.
is fascinating. That was really interesting to see that news release. I didn't know any earlier than anybody who's on this podcast would have heard. But I'll tell you what, that's something that's going to be I think really is going to change the M&A landscape of our industry for the years to come. One of the things that Compass ran into when it acquired, Christie's was in certain markets it had huge market share, and the Department of Justice or the FTC um, didn't like how big their market share was, and so it actually made them divest some of their holdings and created opportunities to, for other companies that might want to gobble them up. Gosh, some of the markets that we're talking about here, they're going to have over 50% market share. Chicago, San Francisco, Los Angeles. Um, there's going to be markets where Compass and all the Anywhere brands together are going to have this huge market share. And so you're going to have a couple of situations happen. Number one, you're going to have agents that may not be happy with this transaction. So there's going to be a lot of attrition that might happen if they don't do a good job staying on top of their retention efforts. So there's going to be a lot of agents, transitioning in or out of these brands to other brands that aren't involved in this transaction. But if they're forced to divest some of their holdings, then there's going to be some tremendous acquisition opportunities for other brokers out there that might be capitalized on the FTC's forcing them to make that sale. But it's an interesting deal. So Compass is huge. They've gotten to a point where these little acquisitions aren't making a dent anymore. One of the big one in Austin with Realty Austin a number of years ago. At that time, that was a decent acquisition. That was, a nice little tick in their revenue, and their agent count and all this and that. But they're at a size now. I mean, they're so
Doesn't move
large
the
now.
needle. Yeah, yeah.
They need these large acquisitions to continue that growth. Anywhere, even with that premium that they're paying for that was, from an enterprise value standpoint, what they're getting with the agents, the revenue, what they're getting is obviously something that could be a tremendous boost for Compass and its stock and its shareholders. They don't expect this transaction to close till the second half of 2026. There's a lot of work that's going to need to happen between now and then. They're going to need to figure out, what's the Trump administration going to force us to do in these markets where we've got huge monopoly, where we've got huge market share. A lot of the stuff that happened with Compass was under the Biden administration, where they were a little less friendly to the business environments, and you had these people in the DOJ, you had these people in the FTC that kind of paid a little bit more attention than they might pay attention to now. So it'll be interesting to see if they force them to divest, and if they force them to divest, what that would do, uh, from an acquisition standpoint, and then also just the agent, migration. How are agents going to do this? If you're a Compass agent and all of a sudden, oh boy, I'm not special anymore because we're merging all these brands together. If you're Better Homes and Gardens or whatever, what's this mean for you?
The interesting thing with Compass and this sort of, monopolistic concern, right? I think that seems to be the play. It's a smart play. When you're big, you try to use that to your advantage. But real estate's hyper local. It's the same thing that Zillow thought that they could use the same playbook that they used in New York City with, I think, Street Easy was the company where they basically said, like, you have to list how we list, otherwise you can't be on the site. And it worked because of the market share they had there. And then they've obviously tried to do this elsewhere with the private exclusives, and it just can't work. So they don't have the market share. I would be really interested, if you have the data, I'd love to get it from you. Like, what markets does Compass exceed 50% market share, right? And then many others they don't. In Austin, I think with this Anywhere acquisition, it'll put them at 19% is where it'll put them here. And my gut is Denver will be the same. I'll go back and, to Mike Delpretti's observation, which is people almost always overreact to things. I think this could become pretty big in some markets, and then I think in many markets it won't really be enough to move the needle. But all that said, it's a huge move, and it's very interesting. They've gotten so large, as you pointed out, that there weren't many big moves to make. What do they do from here? Buy Keller Williams?
Yeah.
Like what's next, right?
Well, you remember those rumors, several months ago with the home services.
Yeah.
I suspect that they probably really were in discussions. When you get Wall Street Journal reporters saying they talked to the deal people, that there was a transaction in play there, then maybe something hit a snag there and they decided to pivot a little bit. That's what's next for Compass. My goodness, it's going to be really interesting to see. I mean, think of luxury. And by the way, to your point, there's probably only about 6 to 8 markets where they're going to where the FTC will really kind of say, hey, look, this is getting kind of, we might have to do something here. To your point, most markets, it's not going to be, it's going to be significant market share, but it's not going to be something that you get regulators to force them to break it up. But look at luxury. I mean, you got, Compass is known for luxury, obviously, and now they're going to have Christie's and Sotheby's. And I mean, truth be told, these are the three probably top luxury brands in the country. There's a couple other ones in various markets, that are really top high-end luxury brands. But my goodness, how is it going to change the face of luxury? What's it going to mean for, for the, Christie's franchising efforts that they were doing? What are they going to white label? What are they going to convert? It's going to be a Herculean effort to get through this process of figuring out how this is going to look after this transaction closes in the second half of next year. We work really closely with the deal teams, both in Compass and Anywhere. And boy, oh boy, they're going to have their work cut out for them. It's really funny. We had, I should have seen this coming. We had a number of deals working with either of them where we're representing the seller and they were interested in acquisition opportunities. And it's kind of like over the last month or so, they kind of gone quiet a little bit. And so this explains why my partner and I were like, oh, well, that's why our deals stopped moving forward, because they had this whale that they were working on. So, Eric, I suspect this deal will go through. There's people saying there's no way that the FTC would allow this to happen.
I give that a low likelihood, especially in this political environment. I give it a really low likelihood that it.
The deal will close. There'll be some divestitures, probably not a lot. But it's going to be, the agent retention issue over the next several years on some of their brands and some of their markets is going to be really interesting, because like you said, everything's like hyper local, and there's some folks who may not feel like going in under this big corporate umbrella. So we'll see.
So to take it full circle, the smallest deal we've talked about today, retention is the most important thing. The agent retention, the book of business retention is the most important thing, all the way up to probably the biggest real estate merger in the last 50 years. The retention is what it's all about. Can they make this work? Can they glom together all of these agents that maybe didn't want to be glommed together? And will they stick around? Can they prove value? So it'll be interesting.
Du jour. And I will tell you, in all honesty, Eric, despite the bad rap the Compass has with some people, they have done a really good job over the last 12 years in their acquisitions with having very little breakage. Their transition team and their operating teams there's been a couple deals where there's been some issues. Nashville had an issue where they, one of the founders broke off and started another brokerage, company. And there's been some other markets where there's been a little more breakage than they've been used to, but they've done historically a really good job retaining their agents. It's going to be fascinating. I think it's going to create some tremendous opportunities for brokerage firms in the periphery of all sizes to really take advantage of some vulnerability that could exist from this transaction from now up until when it closes, and even afterwards as they go through the transition process. We were already in a state of consolidation in this industry for various reasons. Our industry is experiencing a lot of headwinds. A lot of firms don't have the type of culture and leadership that firms like yours do. And they haven't been able to adapt, evolve, and operate in an environment where you've got pressure on the litigation side of things, on the compression side of things, and we've got a market that's just slow right now. I mean, hopefully I'm not going too long here, but just to give you some context, back in 1979, we were at 4 million existing home sales in this country. We had those two recessions back in 1979, back in 1980. The way they combated it was jacking those interest rates up. You and I were babies when this stuff was going on. But, our parents remember the times when there was, 16 to 20% interest rates, right? That created a serious upheaval in the housing market. Right. The next time the housing market saw 4 million existing home sales was 1996. There was a significant downturn. It took 17 years for the market to recover from back to where it was in 1979 to get back to 4 million. In 2021, we got up to about 6 million existing home sales. Market was rocking and rolling. The market was incredible. If you were an agent in a brokerage and you weren't doing really well back in late 2020, 2021, early 2022, there's a problem. You shouldn't be in the business. And that was a time of tremendous growth. The pandemic pop, we'll call it, right? We obviously cratered since then to down to about 4 million existing home sales. We're back down to about 4. How long is it going to take for us to get back to 6? 4 is probably our bottom now. I think we've bottomed out. I think the market's bottomed. I think, agents and brokers who are ready to lean into this market and embrace a bottoming and probably a slow recovery are going to really thrive, because the weak agents, the weak brokers are going to really filter out over the next 2 to 3 years. But, we're going to be, will it be 17 years before we see 6 million existing home sales again?
So
Who
I,
knows?
I mean, I could argue that 6 million was frothy, but I'm no, I'm with you. I mean, we have such low volume right now, and I don't know when it's going to turn back. We have really people are stubbornly locked into their interest rates, and it takes your house has to be pretty uncomfortable for you to say like, hey, I'm willing to trade a 3% mortgage for a 6% mortgage, especially. And when the other thing that exacerbates it is this: we have all this uncertainty in the economy with like a sluggish job market. And so, yeah, a lot of stuff's going to have to come back together. But to your point, disruption causes opportunity. So
Sure.
there will be continued disruption in the economy, to disruption, uncertainty and sluggishness in the economy. And then, yeah, with this big, I mean, it's more than a splash. Yeah, there are people that are smart and continue working hard will be able to come out, will be able to come out ahead.
Oh, yeah.
That's
Oh,
what I
yeah.
tell myself every morning at least.
I agree.
Well, Scott, so thank you for being on. If people need to get a hold of you, how do they find you?
Our website is rtcvaluations.com. My email address is swright@realtrends.com. And, Kirk, I really enjoyed our time together today. I want to reiterate that, especially for agents and teams, there's the opportunity to have transactional value. It just takes planning.
Got it.
Make sure you lean into your visions of when you want to pass this on. Build those relationships, whether it's externally or on the periphery within your brokerage or somewhere else. And there is that opportunity. There's that opportunity to build transactional value in a team.
Well, I can't thank you enough. I think that this is a great guide for anybody. I mean, everybody should think about. If you're in your 20s, you should think about like what's the end game. And as you said, start now. Yesterday was the best time. Today is the second best time. So
That's right.
thank you so much for coming on, and we should do this again very soon.
Absolutely, Eric. I really look forward to it, and I appreciate the opportunity to be on with you.